Hi there, Aaron Dunn here, looking at the key changes from the federal budget around post-retirement. And it'd be fair to say we saw quite an interesting announcement come from the government around an introduction of what's called a transfer cap amount. And ultimately what we've seen there is the introduction of a threshold where earnings are to be concessionally taxed within superannuation. The other area that we saw is around some fairly substantial changes to transition to retirement. There was an expectation that they may remove transition to retirement in its entirety. However, what we have seen is the government make some tweaks to how transition to retirement will operate moving forward from 1 July 2017. And the final thing that we've seen is just a change in the way in which a death benefit payment can be paid. In many instances, or not in many instances, in some instances, we see the ability to top up this payment to effectively claw back the contributions through what's called an anti-detriment payment. Not heavily used within SMSFs, we've done so in the past ourselves for certain clients, but this is a very outdated piece of legislation going back to the Keating days in 1988. So the reality is that the government is looking to tidy up some of this legislation and seeing the removal of these anti-detriment payments. So let's now take a look at what each of these areas actually mean. Alright, so one of the big changes we've seen is around this transfer cap amount and this introduction of effectively a threshold or limit in how the government is going to provide tax concessions in pension phase to superannuation account balances or post-retirement balances. Now, the first couple of important things to note: there are no changes to the way in which a fund will be entitled to a tax exemption, so the 0% tax rate that applies. What they are introducing, though, is the quantum in which that 0% rate will apply. So where you have a balance that is under $1.6 million from 1 July 2017, that amount that is down here, the government is still going to give you a 0% tax rate on this component of your superannuation because you fit within this transfer cap amount. The change here is, well, what happens if you have more than $1.6 million? And this is what the government is now saying, is that you will not be entitled to a 0% tax rate because you are only entitled to have money in pension phase up to $1.6 million, being the purchase price of that pension at 1 July 2017. That's an important distinction. I believe we're going to have to report to the ATO for the first time the pension amounts that sit inside our SMSF clients' account balances. So it is the amount that is above this that will then be subject to a 15% tax rate, where currently we have clients that may have large balances in superannuation and they're paying no tax at all. Now, the other key thing here to note is that not only does this zero tax rate apply, the money that gets paid to the individual where they are over 60 years of age is tax-free to them. There is no change in respect to the tax-free status of any benefit that you take where the member is over 60 years of age. Under 60 years of age, it is still accessible to them. There has been absolutely no change to the legislation around those two key issues. What the government has looked to do is to clearly target the quantums of money that are sitting in pension phase to ensure that the tax concessions are more equitably distributed amongst all taxpayers and the way in which they save for their retirement. So, a couple of important things here. If you are a superannuation member that is drawing a pension, if you have an account balance at 30 June 2017, we have to do nothing. That is my understanding of the legislation at the moment, because you will fit under the $1.6 million cap. Now, we may need to report that information to the ATO at that time, but you will simply carry on as you've always continued to carry on. Where it gets a little bit more interesting is if you are a member that has an account balance in excess of the $1.6 million. Now, what the legislation is going to make you do, and I use the word make you do, is that you are going to have to reduce the amount of money that you have in pension phase to $1.6 million here at 30 June 2017. We would then be reporting, I believe, again to the ATO, that you are starting a pension for pension phase purposes going forward of $1.6 million. What happens thereafter is irrelevant in the context of determining this cap. That is, if you can then grow that pension balance to $2 million, well, that's fine. The fund continues to get tax exemption on all those benefits, on the income that it derives from those benefits. Likewise, if the balance goes under 1.6 million. It's the amount that is above here that you need to think about, well, what am I going to do with that? It doesn't prevent or preclude you under this legislation from accumulating $8 million inside superannuation or $80 million inside a superannuation. The thing is that anything above $1.6 million that is purchased for the purpose of this transfer cap amount will not be given any tax exemption inside the super fund. The income that is derived from that portion of assets will be subject to 15% tax. So there's going to need to be a little bit of work that is done around these key issues here, in particular for individuals above the threshold, because not only are we going to have to reduce that, but in many instances we have clients that have various combinations of pensions running, maybe one, maybe two, maybe three or more pensions. So we have an ability to think about which pensions we might stop, which pensions we might continue, and whether we want to specifically set aside certain assets in here versus certain assets in here. So you need to be working with us and your advisors over the next 12 months to really think about what is going to be the best outcome going forward. Again, there's nothing that says you can't keep this money inside superannuation, but you don't get the tax concession on it. So there may be a balancing act in here between how much you'll retain in super. Maybe you'll pass some money out and hold money inside your own name because of the tax-free thresholds and maybe some senior Australian tax offsets you'll actually get. So it may make sense not to pay 15 where you can derive a level of income in your own name outside of super and pay a rate better than that. But that's some of the stuff you're going to have to work through, and that's where we, and along with any advisors that you have, can help you to really understand some of this detail. So we'll come back to you with further information once we get some more guidance from the government around this proposed change. Interestingly, it's coming to a similar conclusion to what the Labor government was looking to introduce, not looking at a balance here, but rather looking to apply tax on a 15% basis on the earnings that the fund would generate. A far more difficult outcome to administer, but I would think that the government, the Labor government, would be quite happy with this as an outcome because it fits in line with what they were intending to do to deal with those that had large balances and getting quite significant benefits from this type of arrangement. One of the other key announcements that we arguably expected was around transition to retirement. And these transition to retirement pensions certainly have grown over the past 5 or so years for individuals in particular between age now 56 through to 59 years of age. The two key things that we've seen address the issues that the government had from a policy point of view, and that is that this has really gone beyond what the scope or intention of the legislation was to initially do. Transition to retirement was there for individuals that may go from full-time back to part-time work, and the pension was there to supplement that loss of earning capacity. What we've now seen is the fact that we can utilise this strategy to really keep working full-time but maximise the contributions, and we've seen also in more recent times some clarification around the way in which you could actually take that benefit. And it became super attractive to look at transition to retirement, and in reality we've actually started many clients over the course of the past 5 or 6 weeks after some guidance from the ATO on transition to retirement pensions to take advantage of really the loose nature of how the legislation was ultimately drafted. So from 1 July 2017, we are going to see two key areas that are going to change in respect to transition to retirement. One of them is that the super fund is now no longer going to get any tax exemption in respect to converting it to an income stream. So what that means is that the earnings that are derived from a transition to retirement pension are going to be subject to tax at 15%, rather than as it is at the moment, it is currently exempt from tax, or a 0% rate that applies. Now that is obviously going to have some level of consequence on the benefit of the strategy. There's going to need to be some work around whether there is still a benefit of doing the strategy or not, but ultimately the introduction of the strategy at 1 July 2017 means that we still have both the 15-16 year, the year we're in right now, and the 16-17 year to take advantage of what transition in its current form ultimately provides. And the other key area is that we won't be able to make an election to either treat the amount as a pension amount, which would be ordinarily assessable as income in your tax return, versus where we do actually technically have a right to elect to not treat it as a pension payment but take it as a lump sum. And this is really important for individuals between 56 and 59, because you have what's called a low rate cap, or a threshold that you can take out of super for out of your taxable money, $195,000 currently, without paying any tax. So what we're actually doing with many clients is taking that money out of the transition to retirement pension, getting that tax exemption, but then not actually having to pay tax on any of that amount because it sits within the $195,000. So the government is clearly aware of this issue, and they're now going to tidy up that legislation to ensure that we don't have that ability to make that election. So, yep, they certainly don't like it when we get creative or really look to apply the law as the law was drafted. They're worried about policy intent. We're worried about making sure we can get the right outcomes for you as a client. So they're certainly not going to be able to treat the payments as lump sums. Again, this is going to still give us the ability to look at this strategy for the year end 30 June 2016 and also for 2017. So all the work that you may have been doing recently, it's certainly not drop dead at the moment. We need to give up on that. We have the opportunity to look at that for the current year and the following year, but during that period of time we really need to set out and understand whether it's beneficial to continue with transition to retirement from that point onwards as a result of these two key changes. So other than that, and like I said with anti-detriment before, the three key changes that we've seen here is around A, the transition to retirement rules, B, the introduction of this transfer cap amount, and 3, when we look at post-retirement, the ability to top up this anti-detriment payment. So these strategies that we've had previously, we will need to see more detail in terms of the draft regulations and the explanatory memorandum that comes with those regulations before we really can make any assessment to assist you in terms of what we should do going forward. Of course, we're here to, bounce and provide you with guidance on ideas around what we may or may not be able to do. But please, if you do have any questions, you can come back to us and or your advisor, and we'd be more than happy to help out. So thank you for taking the time to have a look at what the impact of the budget changes are, and I look forward to catching up with you in the near future. Cheers.